there's multiple ways to do 1031s. A lot of the smaller 1031s might be just selling one property, buying another property. However, a lot of the deals we are involved in are actually helping people become more passive.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, today I want to talk about 1031 tax deferred exchanges. It's a very, very powerful rule. It's been incorporated in the tax code for many decades, and it's can be pretty misunderstood. So it's something we've been focusing a lot more on over the last year or two, and it's something that's very powerful in a way we've really been able to help a number of investors. So I found that a lot of investors are unaware, or they're vaguely aware about it. So hopefully we can fill in some of the blanks here. One of the key things is timing. Timing is tricky. You have 45 days after sale to identify a replacement property, and you have 180 days to actually close the purchase of the new property. So that gets very tricky. It feels like a shotgun wedding in some cases. There's a lot of vendors to choose from, and I know there's a lot of concern about just using the right team of people to ensure that you have the proper intermediary and the proper attorneys and accountants, because there's multiple ways to do 1031s. A lot of the smaller 1031s might be just selling one property, buying another property. However, a lot of the deals we are involved in are actually helping people become more passive. So that may mean selling 1, 2, 3, 4 single family houses, for example, and then buying into one large apartment building through a structure called a tenant in common, where you actually own a piece of the building, but you'll actually own it alongside a professional syndicate or a professional operating partner that raises the capital and operates that deal more traditionally. So it's a great way to sell some single family rental properties, reclaim more of your time, and structure it in a way that you are more passive, but also in a more institutional quality asset. If you're owning a piece of a 100 to 200 unit building, you're not going to get those 2 a.m. phone calls about repair issues. It's like owning a piece of a business, and it's really the next level of real estate investing. So again, component-wise, first thing you need to do is you need to have this planned out before you start listing properties for sale. In my opinion, you really should have your game plan from day one. And if you decide you're going to go into a 1031 exchange, you should be identifying the types of replacement properties, the types of investments you want to be in before listing, because you never know in this market or in the market last year, you might list and have multiple offers within a week. You need to look at what is your basis for the property. If you have used accelerated depreciation and your basis is down to close to zero, then you'll be 1031ing kind of the entire proceeds. But if your gain is smaller, you may be able to 1031 a portion of your proceeds. You also need to look at your debt service coverage. If you have a certain loan to value and a certain mortgage balance, the amount that you need to have in debt on the new property needs to be similar as well. So if you have a property that had relatively high leverage and you're 1031ing pretty quickly, you may need to be in a property that has a reasonable loan to value. If you had a property that was free and clear, it is likely not as much of an issue. Couple gotchas that we've seen. If you're going to try to do seller financing, it makes a 1031 extremely difficult. Unless the down payment is so much significantly more than the amount that you're holding as a mortgage, that can become a major roadblock for the 1031. So, if you're thinking of doing seller financing, you should kind of have an alternative game plan. The good thing about seller financing and installment sales is they do have their own tax benefits. You actually can spread your capital gain over a period of years as opposed to taking it all at once. However, you do need to be careful about when that loan repays. So if, for example, you own or finance a property and then the borrower decides a year later on December 28th to refinance and they pay you off in full, your entire tax bill will be due that year and it'll come through as probably a surprise to you. So we actually recommended recently to just an investor that we were talking to include either a prepayment penalty or just some language that provided reasonable notice for when the loan would be paid off to avoid that tax issue. That's nobody wants a tax surprise, and again, with proper planning and proper structuring, if you do go the route of owner finance or seller financing, which in today's market with the higher rates and who knows how long they stay higher, but owner financing is going to be significantly more prevalent, I think, in the coming years, just because of where rates are right now, and it just it does make the sale process a lot smoother, but it's not the most conducive to a 1031 exchange. So the key, I think the biggest benefit of these 1031 exchanges in the syndication market is that ability to reclaim more of a passive lifestyle. If you own multiple single family houses, it tends to be really tough to scale. And I think often many investors it's turned into a second job or a full-time job for them. So you can take multiple single families or multiple smaller apartments, sell them, and then identify a larger building to buy in partnership with a large syndicator and or investment firm like ours, where we're sourcing deals like this every day. And with some proper planning, we can work together to identify an area or a number of properties with a number of great operating partners that will work with 1031 investors. Okay, I want to highlight a couple common mistakes for a 1031 is first things first is not looking for the replacement property soon enough. We've had countless calls from people that had 10 days left and just unable to figure things out in time. Usually those people were trying to find their own property as opposed to going into one of these larger partnerships. Second thing is not starting the 1031 in time. You cannot take the money into your own account. You need to have a qualifying intermediary from the start. Acquiring property from a related party, there are some limitations on who you can acquire the property from. And lastly, using a disqualified party as the actual intermediary or closing agent, it needs to be an arm's length transaction. All right, so how the logistics work, and we're not going to go too deep into that at the moment, but in general, you are selling your property, the funds go to a qualified intermediary, and then you are actually going into partnership on the new property as a tenant in common. Now, typically, we are working with syndicated deals where you're part of an LLC and you're signing a private placement, and there's an operating agreement that outlines all the fees. In this scenario, you actually own a piece of the deed. So it is a tenant in common where you have fee simple ownership. However, you don't want to be the one managing the property. So there is typically a management agreement that is set up between what I'd call the lead sponsor or the operating partner, who's going to be the day-to-day decision maker. They'll be the ones that oversee the property management, collect rent, execute on a value add strategy. And, there are fees that come along with that. And there are some rules and regulations, but, the goal is to, in a compliant way, match the fees somewhat to what the property, the partner or property manager would have made if they just took money into the syndication itself. So there's sometimes a little bit of structuring, but in general, you expect to pay a similar amount of fees to what someone who just came in as a limited partner would get. And at the same time, you should make, reasonable expectation of profits similar to what other investors would get. I will say that doing a tenant in common from all of the deals I've looked at is generally a higher return investment than doing a Delaware statutory trust and lower fees. The Delaware statutory trusts have a lot of regulations, and they can't really be a heavy value add. They're really designed to be much lower return, and there's some regulations that I guess seek to make them safer, but I don't even know if that's the case. I mean, we're a big proponent of the value add market, so I don't necessarily know that buying this like a Delaware statutory trust of this Class A trophy property that has probably more downside risk than a lot of deals we're in. I don't know if they're even necessarily safer. So big proponent of doing a tenant in common structure into a syndicated deal over a Delaware statutory trust whenever possible. Quick note on a few deals that we were involved in. We had a client about a year ago go into a property in South Carolina. Pretty easy process. The attorneys and accountants handled most of the work. Luckily, the partner that we work with is very familiar with how to set it up, so they have a good team in place. Worked very closely with the buyer, the investor who was selling the property, their legal team, and the operating team worked really closely together. It was a pretty simple transaction. There's also opportunities to potentially, if you're a large investor in a deal, convert your LP position into a tenant in common. So if you've made, and this is something you need to have made a $500,000, $1 million investment, but if you're in a traditional syndication deal and you've written $1 million check as an example, there is a way, as long as you do it in advance, to potentially convert yourself from a traditional LP into a tenant in common. And there's more to it. There's sometimes the lender is going to need to consent, so it may not apply in every situation, but there is a way to trade out and become a tenant in common in a deal, so that when the property sells and you were just one of the LPs, you may be able to change it over to be in the syndication. You might be able to change over and then become a tenant in common, so that if a property sells that you're part of the syndication, you may be able to then 1031 out of it. Otherwise, largely, if you're in a fund or if you're in a syndicate with multiple investors in general, unless all of the investors are going to consent and you're just going to go from one property to another, usually that's one of the gotchas that stops you from being able to 1031. It's not impossible, but if you've written a 7-figure check into a deal, it's something you might be able to look into with your advisors. A couple other notes. We have JKAM Investments. We have a few interesting deals we are looking at. We are looking at a property in Houston that actually has a 2.5% interest rate that we are going to be able to assume. So those of you that are worried about interest rate risk, we've got 2.5% rate, long-term debt. It's a HUD loan that's being assumed. There's no income restrictions on this HUD loan. It's just happens to be through HUD. It's not one of those programs that forces Section 8 or low-income housing. It's actually almost a Class A asset in the medical center of Houston. And also looking at a marina and RV parks. That's an asset class that's been growing, something we followed for recent years. And it's something we're pretty excited about, very similar to self-storage, very similar to mobile home parks. It's an asset class that's largely owned by mom and pop investors. And we're excited. We've got a really good operating partner that's very experienced. They all came from corporate roles at larger operators, and now they've started a fund and a syndicate that's going to be buying and rolling up these complexes. These marinas and RV parks, doing value add, and they have the connections to sell them. If they can build up a significant amount of properties, this is a pretty straightforward private equity roll-up strategy where you build to a scale where a larger operator will pay a premium and acquire at a lower cap rate. So it's something that JKAM we're super excited about. Spent a fair amount of time reviewing the asset class, and one of the best parts is the cash on cash will be higher from day one. So it will supplement the cash flow for our fund, our diversified fund, and those looking for individual deals that have a higher cash on cash return than a typical multifamily, which I still love. But we are going to likely have some opportunities for higher current cash on cash through RV parks and marinas. And the interesting part is these are all inland marinas. These are really parts of ones that are on lake, so we're not as worried about hurricane risk or some of the just saltwater issues that create some challenges. So that's it for today's episode. We will be back next week, and we encourage everyone to please follow us, follow our YouTube channel, JKAM Investments. Please leave us a review on iTunes or Spotify. And connect with us on our social media, whether it's me personally, Jack Krupey on Facebook and Instagram, or our company page, JKAM Investments, on Facebook, Instagram, and LinkedIn. So thanks again for listening. We'll see you on the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.